So my equity as of May 19 is 90,000, and that's across all my accounts. So my TFSA, my RSP, my margin account, which is a negative 16,000, and my RESP. All right, so if I go under orders and execute it to look at my trades today in my margin account, I opened one. First of all, I opened the June 19, 279, 274 put spread. So like always, I open one on Monday, Wednesday, and Friday. I collected $79 and it expires June 19. And then I closed two put spreads. So I closed one, the one that had a June 10 expiration with a 270 strike. I closed it for 36 cents. So now if you look for when I opened this June 10th, so you can see it right here on this line, June 10, expiration 270, 265. I opened it for $71 on May 11, closed it May 20th, so 9 days later, I closed it for 50% profit. I also closed this put spread here, June 8th. So you can see on this line, I opened it May 8th with an expiration of June 8th, 274, 269 put spread on the SPY, collected $79, closed it today for $37, so more than 50% profit. Now this one here, it got tested last week, so I sold a call spread against it. So if I go to positions, you could see that June 8th has a call spread of 300, 305. This I sold just to reduce the max loss in case the SPY was going to continue to drop, when the SPY was trading at 272 last week, but then decided to recover to 297 this week. So really, really just absurd. I don't know what's going on. Doesn't make sense, and it's annoying. Usually I should be happy that the market's going up, but for some reason it's actually going against me. So I'm stuck with this call spread right now with a 300 strike for June 8th. What I'm going to do is, of course, I'm going to watch it. If SPY reaches 305 before June 8th, I'm going to bring the put spread higher. So I'm going to sell a put spread maybe at, I don't know, 280, 285, depends where we are. But this is the put spread that I closed today. So the June 8th put spread was part of this trade. I closed it alone because I wanted to confirm the profit of 50%, just in case we actually go for the drop that we're all expecting. So if the SPY actually drops, or if the market drops like we all expect, at least this call spread will be profitable, and this call spread here of May 29th, 295 strike, will be profitable. Right now, this 295 is in the money because the SPY is trading at 297. But I've got 1 week and a few days to go, and hopefully it trades below 295. And if it doesn't trade below 295, if it trades at 297, well, my cost to close it will be $200. It won't be $500, so it's not going to be max loss. So it really depends where it trades. But in the meantime, if it continues to go up, the SPY, I'm going to sell a put spread maybe at 285 or maybe even 290. Worst case, I'll sell a put spread at a 295, 290 put spread. So the trade will become an iron butterfly. That'll be worst case scenario. So I'll collect as much as I can collect, but at least I minimize max loss. And who knows, if SPY trades close to 295, I can actually come out of it with a profit. But if SPY trades above 300 come May 29th, then it's going to be a max loss of $500 minus any premiums I collected with all the trades related to this expiration. But yeah, I've been closing a lot of put spreads lately. I mean, yesterday I confirmed $81 of profits. Today, $77 just with these put spreads on the SPY. It's just ridiculous. It helps a lot when the market is rallying up. But now I've got a problem with my covered call on the Qs. It keeps getting worse as the Qs is flying like this. I mean, my purchase price is 221. The stock is trading at 231, so I should be happy. But I sold a covered call at 212, May 22nd expiration, so this week's expiration. So my max selling price is 212, but my cost is 221. And the stock is trading at 231. So I'm not only am I'm risking losing my shares at 212, which is below my cost, but I'm missing out on appreciation between 231 and 221. So that's really annoying. All I could do really is I have to buy back the call option and roll it forward, and I'm just waiting for the market to drop because this is really ridiculous. It's going up way too fast. So right now, if I wanted to roll it to a higher strike, let's say a 213 strike, I'm gonna have to go so far out. Maybe not 1 week out, but I'll have to go maybe to June 5th. Not even. So if I go to June 5th, I could do it for no credit, no debit. So that's not bad. If I go to June 12th, I could do it for a credit. But I'm 1, 2, 3 weeks away. Usually I go for the following week, but I'm not able to. Why? Because the stock is trading so high. So that's just annoying right now. And in my RSP, I've got the same thing, cover call on IWM, but this one's a little bit safer. I mean, my strike is 134 and the IWM right now is trading at 134. So I'm hoping that by Friday it stays close to 134 so I can roll the call option forward next week and move a few strikes higher as well and collect a credit while doing that trade. And simply the way I would do it is just click create order. Automatically gives me the shares, but I'll remove the shares here. I'll keep the option that I'm buying back, the May 22nd 134 strike. I'm gonna click add call, but I want to sell it, choose next week's expiration. If I pick the same strike and I do this right now, I can collect $159 in premiums. But if I go for a higher strike, let's say 138, I can collect, I guess I can't collect anything. If I go for 137 strike, I can collect about 20 cents or $20. So I'll collect $20 to move the call option forward, and I'm getting $3 of extra capital appreciation in case IWM continues moving higher. But I really don't think the market should be moving this fast. I think we're in for a big surprise. I mean, airports are still closed. Airlines are still not functioning at 100%. A lot of businesses are going to go bankrupt or are losing a lot of money. People are losing their jobs. And Qs is almost at all-time highs. It doesn't make sense. If you look at the Qs here, so 52-week high of the Q is 237.47. So this was before the crash of March, right? 237. It went all the way down to, I believe, like 160 something, 167, 164.93. So that was the low in the crash, and now it's already up to 231.75. Does that make any sense? I was actually going to make an earnings trade on Expedia, but then I said for sure it's going to drop because no one's traveling, no one's booking, yet after hours it went up. Makes no sense. I was also going to do an earnings trade on this here, Take-Two Interactive Software. I was going to do a put spread at a 130 strike, expiring June 19. So right now after hours is dropping a little bit, but what matters is tomorrow, really. But even if it drops a bit, the put spread would have been profitable, but I didn't do it. Now here's a trade that I'm thinking of doing for earnings, NVIDIA. I'm scared to do it, but I'm really tempted. So now I've got level 4 options in my margin account, so I could start selling naked calls and naked puts. So I'm actually thinking of doing a naked call on NVIDIA as an earnings trade. So NVIDIA announces earnings tomorrow after hours. So May 21st after hours, NVIDIA is going to announce earnings. So May 22nd, there's going to be a volatility crush in the option premiums. Plus, it's the expiration. So it's going to be the last day of the option. So it's going to be the expiration date of the option. So it's going to decay really fast. So it's got two things that's going to make it decay really fast: the volatility crush after earnings and the fact that it's the last day of expiration. So I was thinking of selling the 450 here. Let me just click anywhere here and choose the 450 call option. And as you can see, it's trading for about anywhere between 29 and 41 cents. So I was thinking of doing 10 contracts of that. So if I do 10 contracts, let's just see how much buying power is required. And I go for 41. I'm not going to send the order, but just to see what the buying power says. So I could collect $410, but my buying power or the change in maintenance excess is 17,000 US, and the change in buying power is about 58,000. But it's a one-day trade. I can close the trade the next day. Commission is $12.46 because it's 10 contracts. But the strike is 450. So NVIDIA would have to, for this trade to be a loser, NVIDIA overnight would have to go from 358 to 450 for this trade to be a loser. So chances are it has a high chance of being a winner. So if I could do this trade, collect $400 in one day, I mean, that would be pretty good. I'd be happy with that, but I'm always a little bit scared, but it's something on my mind. I'm tempted to do it. I have a day to think about it anyways, but just wanted to share it with you. Let me know what you think as well. I mean, it's a high probability trade. I mean, it has a good chance of winning what are the chances that NVIDIA goes from 350 to 450 in one day after earnings. So make sure I click do not send. And then I could do the put side as well. If I do the put side, I can't go as far. So if NVIDIA is trading at 355, I could probably do maybe 300, and I can collect, let's say, 42 cents. Let's say I do 10 contracts. Let's see how much buying power is required here. So in this case, I don't have enough buying power to do the put side because it's asking for 177,000 US. But maybe I could do 6 contracts. I still don't have enough buying power, and I'm collecting less credit. So I think I'd be doing the call side. If I do this trade naked, I'm going to go on the call side. So sell the 450 naked call. If I do my regular earnings trade, so my regular earnings trade is usually pretty safe. It's a vertical put spread or a put credit spread. I go 30 days out, so I'd go to June 19 and I would sell the expected move short put. So I'd get the expected move by looking at what the stock is trading at right now. So 360, $25. So it's going to be about $50 out. So I'd go $50 lower than the current market price. So I would go at a 310 strike on NVIDIA and then buy the 305, but I should be on the put side. So, and then buy the 305 put option. So this is my regular trade, regular earnings trade. And as you can see, I could collect something decent here. I could collect maybe $1.10, so $110 while risking $390. But usually because of the volatility crush, I can close this trade the next day for more than 50% profit. And if it goes against me, I've got 30 days to manage the trade by selling call spreads against me. So this is the safer trade, but I mean, it's only going to be $80 or $50 profit after commissions. The other one is more tempting because it's so far out. It has a much better chance of winning, so it allows me to do more contracts. But at the same time, I'm always afraid. I'm always thinking, what's the worst case scenario? What if it does happen that NVIDIA goes from 350 to 500? Because if that happens, I'm going to lose $50 per contract. So if I've got 10 contract, that's what, 5,000 or is it 50,000? Yeah, that's $50,000 actually. All right, so let me know what you think. Leave in the comment section below. If you have any questions as well, leave them in the comment section below. And like always, if you can open an account with Questrade to trade on the stock market, use one of my referral codes below. One of them gives you up to $250 back depending on how much you deposit. So $1,000 gets you $25, 10,000 gets you $50, and so on. Or you could use this other referral code that gives you $50 in free trades with a minimum deposit of $1,000, of course. All right, thanks for watching.